One of my favorite option strategies is the short put. I love selling puts. I sell puts on stocks, ETFs, futures. It's a wonderful strategy. I think it's a great beginner option strategy. If you're brand new to options, you need to learn the 4 basic options trades, obviously: buy call, sell a call, buy a put, sell a put. And of those 4, I think the short put is the best of those 4 basic option strategies. So if you're a beginner, selling puts is something you need to start doing. You need to know how this particular option strategy works. And a lot of people ask me about my particular rules. They see me selling puts over and over again on various products, and they want to know my rules. What are DT's rules for selling puts? And that's what we're going to discuss today. So today we're going to discuss my short put strategy, how I trade and manage short put options. So the very first thing I want to discuss is that this is my favorite option strategy. It's the option strategy that I use the most by far, and I'm not alone in this regard. I think most options traders that prefer selling options rather than buying options, their main go-to trade is selling puts, right? Selling puts is kind of a core strategy for many of us. Why is the short put such an important core strategy? Well, the short put is great because when you sell a put that is out of the money, it has a high probability of profit, right? It wins a lot of the time, right? It has a very high chance of winning. That's why the short put is a fantastic strategy. You're going to win on most of your trades when you're selling out of the money puts. The short put also, it does not require any technical analysis. If you're doing reasonably short dated trades like I do, where most of the time I'm in and out of my trades within just a few weeks, fundamental analysis really serves no purpose at all. So you really don't have to worry about things like technical analysis, fundamental analysis. Technical analysis is often used to try to guess the direction of a market. And with short out of the money puts, you don't have to guess the direction of the market because you're out of the money on these options. You really could profit if the stock goes up, if the stock goes down, if the stock trades sideways. So technical analysis becomes completely irrelevant when you're selling out of the money options. And while the short put is usually referred to as a bullish strategy, it's really more of a neutral to bullish strategy. Again, because we're selling puts out of the money, we really don't necessarily have to get the stock to move up. It can stay still. It can go down as long as it doesn't go down too far because, again, we sold it and put out of the money. So don't think of a short put necessarily as a balls out bullish strategy, right? It's more of a neutral to bullish strategy. So let's take a look at the risk profile of a short put. If you're brand new to options trading, here is the risk profile of a short put. So this circle here indicates where the stock is currently trading, and then we sell a put out of the money. You can see the risk profile. If the stock finishes above our short put, we win the maximum amount, and if it finishes below our short put, we start winning less until we hit a break-even point, and then we start losing, and we potentially have unlimited losses to the downside on a short put. So a short put is a put option that has been sold rather than bought. When we're talking about options trading or trading in general, anytime you sell something, right, that is a short trade. When you buy something, that is a long trade. Do not confuse long and short with being bullish or bearish. Some people get that confused. When we're talking long or short, it simply means, did you buy the option or did you sell the option? So if I sell a put, it is a short put. It does not mean that I am bearish. It actually means the opposite. In this case, a short put is actually a bullish strategy because I want the underlying price to increase. So short puts, they're credit trades. When you sell an option, you get a credit. When you buy an option, you pay a debit. In this case, a short put, we receive a credit, and that credit we receive on the trade is our max profit. So if the underlying stock at expiration finishes above our short put, I receive the max profit. What is the max profit? Well, that's the credit I received up front when I sold the option. I get to keep the full amount. Now at expiration, if we finish below the put, then I might have to give up some of that max profit. And if it finishes well below our short put, below our break-even point, then I actually really start losing on the trade, right? And I can suffer, again, some pretty incredibly large losses in a serious downturn. So the table here at the bottom of this chart, the direction, we're bullish on a short put, right? It's a bullish trade, more of a neutral to bullish trade when you're out of the money. For volatility, we want the IV rank of the underlying stock or ETF. We prefer to have high IVR because the higher the IV, the better it is for our credit. Now, the max risk on the trade is undefined risk all the way to zero, to the downside, right? So you want the stock to go up. If the stock starts moving down, you are open to potentially undefined risk. What is the max reward? Well, that's the credit you received when you sold the option. So let's talk about my basic rules when selling a put. First, good liquidity is absolutely required. I want to check the stock's share volume. So does it trade millions of shares every day? Even though we're trading options, the share volume could give you a clue whether a lot of people are interested in this product or not. If not a lot of shares are trading, then I guarantee you not a lot of options on those shares are trading. Also check the option volume, check the option open interest, check the bid-ask spread of the options, and also check the options chain. If it doesn't have a weekly option cycle, if all it has is monthly option cycles, chances are that's not a very liquid product. So let me switch over to my trading platform and I'll show you this in action. Let me choose something that I don't have a position in. Let's go to Apple. And if I go to the options chain, well, first let's check the share volume. And I can see that Apple traded nearly 40 million shares on Friday. I'm recording this over the weekend. And 40 million shares trading, that is very nice, especially considering Apple's a very high price stock, trading nearly $300 a share. And the fact that 40 million shares were traded, that's a lot, right? This is a very liquid product. And then if we take a look at the options chain, it has monthly option cycles, which of course you would expect. And it also has weekly option cycles as well, which is a good sign. And then let's go into one of the monthly option cycles, which will be the best typically as far as liquidity. What are the bid-ask spreads like? Well, 15 cents wide, 20 cents wide, 20 cents wide, 15 cents wide, 20 cents wide. Those are really tight bid-ask spreads. I mean, it's not extremely tight, but pretty tight on something. Again, trading right now, it's trading around $277 a share at the time of this recording. That's a high price stock. And to have a bid-ask spread on many options of 15 cents, that is really good liquidity. And then I could check the option volume or the option open interest. Right now I have open interest as a column, and I can see thousands of open interest on every strike. In some cases, tens of thousands of open interest on some of these strikes. So again, Apple, one of the most liquid products you could trade options on. Now let me go to something a little less liquid. Here is a product I sometimes trade because I like the company, GitLab, but this is not a terribly liquid stock. You can see how many shares of this traded on Friday. Well, a little less than 3 million, and it's only a $39 a share stock, right? So it's not like it's an extremely high price stock. You would expect many, many millions of shares to trade if this was a liquid product. Now the options chain has monthly cycles and weekly cycles, so that's a good sign. But let's go to the February monthly cycle, which you would think the monthly cycles would be the most liquid. The bid-ask spread on that particular call there, $2.20 wide, extremely wide. Here's another one, more than $2 wide, $2.40 wide. Here's $2.10 wide, right? This very, very wide bid-ask spread. This is untradeable because you could not get filled at a fair price. You're going to get screwed over on both entry and exit on your options trades on things that are very illiquid. So avoid products like this. You can also check the open interest, and nothing is trading. 9 contracts on that particular call, right? Remember, Apple was trading tens of thousands of contracts on every line. Here, only 46 contracts have traded. So yeah, this is a product I would avoid trading. The next thing I want to check is I want to check the IV rank of the underlying stock. So the underlying, if it has an IV rank of at least 30 or more, then it's good for selling options because the premiums you get for selling those options will be higher. If IV rank is less than 30, then you're not going to get very good premiums for selling options on it. So I typically avoid selling options on things with really low IV rank. And IV rank, if you're using TASTYTRADE as your trading platform, is always right here next to the ticker at the top. So GitLab has an IV rank of 32. If it had decent liquidity, that would be great. But remember, liquidity is king. If a stock is not liquid, you can't trade it no matter what else. And there's no reason to look at anything else if it's not liquid. So let's check Apple. Apple's very liquid, IV rank of 1. This would not be a great thing to go and sell options on right now because the premiums on it are just going to be a lot lower than they would be if the IV rank was 30 or 50 or 70. So right now, I mean, you could go sell a put, the 17 Delta put in Apple for $289 credit on a buying power reduction of 2,700. But if the IV was a bit higher, you might get this same put. I might get $3.50 for it or $4 for it if IV was quite high. So right now you're just not going to get as much as you could on a product that has better IV. Also, one of the things that makes short options so great is the fact that when you sell an option on something that has a really high IV, typically IV over the life of the trade will come down a little bit. And short options benefit from that IV contraction. And you're not really going to get an IV contraction on something that has an IV rank of 1 like Apple does right now, because IV is so low, there's very little for it to come down from, right? And chances are actually that IV will probably rise over the life of a trade, which is bad for a short options trade. So that's why you need to pay attention to IV rank. Now let's talk about days to expiration, the DTE. So you found something that has pretty good liquidity, and maybe you found something that has good IVR. Let me go to something that has pretty good IVR and pretty good liquidity. So if I go to one of my watch lists, let me go to one of my stock watch lists. I'm going to sort by high IVR. Micron. Micron is a pretty liquid stock. Right now it has an IV rank of 60, partly because as I'm recording this, it's about to report earnings, so that helps IV. So it's got good liquidity, which is number one. If it doesn't have good liquidity, we're not going to trade it ever. And then it has really good IVR, so let's go ahead and sell a put. What DTE? Well, typically for me, I like going around 60 days. So what is the monthly expiration? I don't want to trade weeklies because the weeklies are less liquid. What monthly expiration right now is closest to 60 days? Well, the February monthly cycle right now is 68 DTE, so really close to 60 days. So let's go into this cycle, and then what delta do I want to pick? Well, when it comes to delta, there's a couple of different ways to think about this. Most of the time when I'm selling puts, I'm not trying to get assigned shares. I just want a really high probability trade that's going to win most of the time. And I like winning on most of my trades. And I like winning around 80 to 90% of the time. So I want trades that give me around a 80 to 90% probability of profit. So in terms of delta, what is that? Well, that would be the 15 to 20 delta mark. So here in Micron, maybe I go sell the 15 delta put, which right now is the 185 strike. You can see I get a credit of $650 for selling that put. The buying power reduction is $1,800. That's really good risk versus reward as far as the buying power versus the credit received. That's like 3 to 1. That's exceptionally high. You rarely get such good risk reward. And part of the reason we're getting great risk reward on that trade is because of the really high IV rank, right? That elevated IV really gives us a great price on that credit that we receive selling this option. Now, the 15 delta put, you would think you would win about 85% of the time is what the pop is going to be roughly. But if you want to, your trading platform will give you exact numbers. Right now, I'm recording on the weekend. There's no trading going on. It's reporting that the pop on that particular option is 81%. Whatever it happens to be, it'll be around 85%. It may be a couple of percentage points above or below what the delta is, but it's going to be somewhere in that 80 to 90% range. It's going to be the pop on the trade. So we're going to win, if we trade this 10 times, we're going to win on 8 or 9 of our trades out of every 10. And because I manage my trades at 50% max profit, the P50 number here is above 90%. So I'm going to win a little more than 90% of the time as long as I take this off at a 50% winner, which is usually what I do. Now, I'm not trying to take assignment of shares. That's why I like going in that 15 to 20 delta range to sell my puts. Some folks do want to take assignment of shares. Maybe you're trying to get shares of Micron for whatever reason. You want shares. Maybe you're a long-term passive investor and you're trying to build up a share position in whatever the underlying stock is. And you don't want to be out here at 15 deltas because you're going to win 90% of the time. And you're never going to get assigned shares if you're constantly winning on all your short puts. So you may want to bump up the delta. Maybe you want to go somewhere between 30 and 35 deltas. Maybe I'll go to the 32 delta. I get a 1670 credit. That's a $1,600 credit on a buying power reduction of $2,600. The buying power, of course, is going to go up, being a much riskier trade, but still a really good risk reward on this. The pop, 67%. I'm still going to win 2/3 of the time. So even with a 32 delta put, I'm still going to win most of my trades, but I give myself a better chance of getting assigned if I'm trying to get assigned. So for me, I want to be 15 to 20 deltas if not trying to get assigned. If I'm trying to get assigned, I'll be 30 to 35 deltas. And I know some people on YouTube, you'll see people selling like in the money or at the money puts, which have less than 50% chance of winning, right? But I hate these kinds of trades because I want to win on most of my options trades. If I'm trying to purposely lose to get assigned, you know, if I want to sell a 70 delta put, a very deep in the money put, I just buy the shares outright. I just go ahead and buy 100 shares now. Why fool with the options at that point? So I am never trying to go in the money with a short put. One other thing I'm not trying to do is I'm not trying to sell puts that are very far out of the money. So anything less than a 10 delta is typically not where you want to be because there's still risk, right? Remember, you have great risk on a short put potentially. Now, you know, it's very rare, but outlier events do happen. A stock can crash 20, 30%, and it doesn't matter what short put you sold, whether it be this 32 delta or this 15 delta or the 2 delta. If the stock crashed 30%, you're probably in trouble no matter what put you sold, right? So don't go way out of the money, because if you go, say, and sell this 5 delta put, you get a $2 credit. You get a much smaller credit compared to the credits we were getting up here. And yeah, you're going to win on the trade 93% of the time, 95% of the time if you manage it 50% of the time, but that's still 5% of the time you're going to lose, but you're not going to get compensated for that loss the way we're getting some real compensation up here at the 15 delta. So I'm taking the risk, but I'm getting paid to take risk. And of course, at the 32 delta, I'm really getting paid to take some risk. Out here, you know, in these single digit deltas, you're just not getting paid enough to still be taking that unlimited risk to the downside on a trade. So if you're getting less than 10 deltas on a short put, you really need to ask yourself, is this worth it? Most of the time, it's not. One other thing to consider, if you're going to sell multiple puts on something, you don't have to enter the full position right now. For example, if I go back to Micron, let's say I want to start selling some puts in Micron. Maybe my size is 4 puts. Well, I could sell 1 put today, and then later I could sell another put because maybe Micron moves up or down. Maybe it moves down, so it moves against this position to where my 15 delta put is now like a 20 delta put. Well, you know, I could always, you know, now sell the new 15 delta put. You know, I could ladder into the trade on the way down and, you know, basically average down my pricing on some of these puts. So, you know, you can always go into a trade if it's a trade you want to leg into a little bit. What you can do, put on half the position up front and then put on half the position later. And again, especially if you get a move against you early on in the trade, well, you only put on half the position. Now you can put on the other half at a better price, and you essentially average down the whole position. And you can also ladder your short puts by selling your positions at different expirations. So if I was going to sell 4 puts, for example, in Micron, maybe I do 2 this month and then 2 the next monthly cycle. So they're in different expirations. That way, if a trade goes against you, the 2 in the front month are in a lot more trouble than the 2 in the back month. And you're not facing a situation where all of them are in the front month and are in trouble. You only have to deal with 2 that are really in trouble right now, and the other 2 in the back month are, you know, they can sit for now. Now let's talk about managing your trade. So when should you close the trade or roll the trade? So typically on short puts, I suggest closing or rolling the trade at 50% max profit or 21 DTE, whichever comes first. So if I sell my 15 delta short put at 60 DTE, when will I close this trade? Well, I'm going to close the trade if I hit 50% max profit. So if I get 650 credit for this, if I ever get to a 325 credit on the trade, I'm going to close the trade for a 50% winner and move on. Now, if I never get to 50% max profit and 21 DTE eventually rolls around, I'm going to close the trade at 21 DTE no matter what. So at 21 DTE, we close the trade for a smaller winner, you know, smaller than 50% because it never got to 50%, or a small loser if it happens to be a small loser. Or if I want to, I can roll it out in time. So let's say we get to 21 DTE. Let's say, you know, here at 19 DTE, I'm in the trade. I sold a 15 delta put that over the life of that trade now is a 35 delta put. It really didn't work out that well for me. It's profitable, but it's a small profit on the trade. What would I do at 21 DTE? Well, I would roll this position out in time, right? I would just buy that option back and then go back out to the new 60 DTE cycle, whatever's closer to 60 DTE, and then sell the new 15 delta put. That's all you do, right? So at 21 DTE, take the position off or roll it put at 50% of max profit, you always take the position off and lock in that win. Now for me, when I roll an option, I always want to roll for a credit. If I have to pay a debit, I don't want to roll the option. Usually I just close and accept the loss. If you can't roll for a credit though, what you could do, if you don't mind running the wheel and you don't mind taking the shares, so if it's a stock, or especially if it's like a market ETF that you don't mind taking shares of, something like SPY or QQQ or a sector ETF like XLE or something like that, if you don't mind taking the shares, you could just let it ride, let it go to expiration, and then take the shares, because market ETFs, sector ETFs, they're going to come back to you eventually, right? They'll always have a positive drift, so you'll eventually get your money back on those if you just want to take the shares. But shares are expensive. Typically, I don't want to be assigned. Typically, if it's a small loss, I'll just take the loss and move on. If you do hold the expiration and take assignment of shares, what do you do now that you've got the shares? Well, you immediately turn around and start selling covered calls against your new share position, and you start running the wheel if that's what you want to do. Now, what happens when you want to defend a short put because you're staring at a loss, you don't want to take the loss? What happens when you sold a 15 delta put and, say in this case, Micron went down in a big way? My 15 delta put is now a 50 delta put. And I'm down hundreds of dollars, maybe thousands of dollars on the position. Now, what do I do? Well, the first thing you need to do, part of the reason why you're down on this position is because the deltas grew on you. 15 deltas is very safe. You know, each dollar that Micron moves down, I only lose $15. But as it moves down, the deltas on the option increase until now you've got a 50 delta option, meaning every dollar Micron moves down. At this point, I'm losing $50 every single dollar that Micron moves down. That's why this loss gets big and why it grows exponentially. You've got to get that delta number down. How do you get that delta number down? Well, you've got 50 long deltas on a 50 delta short put. You need to cut it at least by half. How do you do that? Well, you go sell a call. So in this case, if we got to cut it at least by half, go sell a 25 delta call. And now instead of having 50 long deltas on this position, you only have 25 long deltas on the total position. So now if Micron keeps going down, instead of losing $50 a clip, you're only losing $25 a clip for every dollar it goes down. So that's how you defend. You've got to reduce the deltas. That is always the key when you're defending an options position, is you need to reduce your deltas. For example, on a short put, sell a call. You know, sell a 25 or 30, 32 delta, whatever, you know, sell a good chunk of deltas against that to get that delta number way down. And probably the most important thing to do to defend yourself in a short put is just stay small in size. Make sure you're comfortable with the risk on the trade. If it's a stock that you can comfortably take assignment of, that's a good thing. If you're selling puts on something you can't take assignment of, then you probably shouldn't have sold the put anyway, all right? Because you could get early assigned at any time on any position. It's rare early assignment, but it can happen. So just stay small. You know, as long as you're staying small, then you really are not in that big of trouble most of the time on these positions, because in this case, if that put went against me, I mean, I just take assignment, right? You just take the shares and then start selling your covered calls against it, and you'll be all right. Where people get in trouble here is then they end up selling a put on something they have no business selling a put on. It's too big of a position. They get assigned shares. The share position becomes a really big position. Maybe it takes up 25% or even 50% of their total net lick account value. They've got all of their money now tied up into the share position that they didn't even want, and that is dangerous. That's not where you want to be. So just make sure you're keeping things in check as far as size. Also, if your bullish assumption ever changes on an underlying stock, you know, if all of a sudden you're in a short put position and you're like, man, this thing I'm trading right now, whether it be Apple or Nvidia or gold or silver, whatever it happens to be, the overall stock market, maybe you're selling puts on SPY and you're like, man, I think the market is not looking good right now. I think it's about to take a dump. Well, get out of that short put position, right? There's nothing wrong with just closing the position. If your assumption on any options position changes, then get out of your original position, because there's no point in sticking in it if you don't really have any faith in that position anymore. Just get out of that position and move on. Find something else to trade. So there you have it. Some of my thoughts on selling puts. Those are my guidelines on my short put option strategy. If you want to learn more about options, check out my book, The Super Wheel Option Strategy. This book is about my favorite option strategy, which is the wheel strategy, which combines selling short puts and then turning around and selling covered calls once you get assigned shares of stock is a fantastic option strategy, especially for people that are brand new to trading options. You'll find a link to the book in the show description. Peace, guys.